Hello and welcome everyone to another market commentary from StashAway. With us, of course, our Chief Investment Officer, Freddy Lim. Hey, Freddy, how are you?
Hey, Philip. Nice to see you again.
I know
been a
it's
while.
nice to see you as well. And our Deputy Chief Investment Officer, Stephanie, how are you?
I'm good. Hi, Philippe. Hi, everyone.
Yeah, it's good to see you, everyone. It's been 2 weeks. Lots have happened. And so we want to, wrap it up as quick as we can. But actually, a lot of things has happened, as I said. So to start it off, Stephanie, there and Freddie as well. So there was a lot of talk about inflation, right? And we talked about how much of it is priced in with the Fed. They spoke, I think, 2 days after we had our last call together. So maybe you want to give a little bit of an update. What has happened? What is kind of the market doing at this point in time? Because we've been seeing a lot of volatile trading, right? Like it starts up like, the Dow and the S&P start up like 400 points. They end up, even. They start 400 down. They end up even, right? But not so much is happening, but a lot of movement during intraday trading. So what's your view on that?
Yeah, I guess year to date, you're right. U.S. equities and bonds have been among the worst performing asset classes globally. And that's a lot due to the shift in kind of policy stance of the Fed, right? If you remember in December, they basically pivoted saying that inflation is on their radar again. And that triggered quite significant tightening of monetary conditions in the U.S. Chiefly, if you look at some of the U.S. interest rates, particularly short rates, they have been rising quite a bit. And I think at the beginning of the year, the market was pricing in around 3 to 4 times of Fed hikes. Now, as of the latest day, the market is actually pricing in more than 5 times, actually close than 5.5 times, 125 basis points of Fed hikes in 2022. So even without the Fed hiking, the market basically has done the tightening already. And that is, of course, due to high inflation, as we've been flagging for the past few months. And this inflation pressure we've seen is expanding like outside of the US as well. Right? If you look at the latest PMI global survey, actually they ask all these purchasing managers how they feel about inflation pressures, both in inputs and wages, and that index actually is sitting at a multi-year high. So we see this kind of persisting for quite a bit. So far in the US, if you look at core inflation, i.e. stripping out energy, most of that core inflation is actually in goods inflation. And that's due to like disruption in supply chains, like COVID shutdowns, etc. But if you look at the latest non-farm payroll report, which comes out every month in the US, the average hourly wages have also been starting to rise quite quickly in the US. Chiefly in the past month, they've risen about 5.7% year on year. So that is also a multi-year high. So that's kind of what we're seeing in the U.S. Outside of the U.S., of course, like there's conflicts on Ukraine, and the importance of that is because if there is a economic sanction on Russia, basically Russia supplies 1/3 of the natural gas in Europe and 1/4 of the oil consumption in Europe. And so far, we've seen like oil prices climbing, partly because of market concern on this economic sanction. Particularly as Europe is running quite low on inventory, and also we're going through the winter season where demand for natural gas is of course naturally quite high. So this is something to watch out as well. And with no de-escalation in Ukraine, like energy prices are quite likely to stay high.
Freddie, anything to add from your point of view? So do you think the markets are fully pricing in these Fed rate hikes now, which the Fed is trying to combat that inflation number as well with those rate hikes, right?
Well, as you have heard Stephanie mention a couple of reasons why the fundamental core trend of inflation will persist throughout this year. You start hearing 5.5 times rate hikes of 25 basis point priced in. That sounds like a lot for people historically, but there's a chance that the Fed may just do its first hike with a 0.5% hike rather than a traditional increment. And that's why the market has to price in more, or perhaps even take it to 6 for this year. And is actually a good thing, because as long as the market is pricing close to what it should fully priced in, and yet equity markets reaction in all historical contexts, this is very benign. That means the resilience in the market remains, the growth momentums remain strong. At least in the US, is much stronger than in the rest of the world. That actually means it's a pretty good news. We're close to being in a good news for financial markets again. Nonetheless, as Stephanie highlighted again, there are a lot of pressure points in various places, which is why portfolio should still sort of readjust slightly to fine-tune your protection against inflation. It's not just like, as you knew, we've done a reoptimization this year, very early on in January. And one of the reasons is to maintain the effectiveness of those inflation protection. What do we mean by that? Because something may benefit from higher inflation, but it's already fully pricing something and is probably even overvalued. The effectiveness of the inflation protection instrument may be in doubt going forward. And hence, we're making a lot of fine-tuning to just maintain that effectiveness. So I probably jump ahead, Philip, but if it's sort of the angle all to do with inflation and valuations.
No, absolutely. And I do want to get into that point, right? I do want to talk a little bit about that reoptimization that has happened over the last 2-3 weeks in people's portfolios of the people listening to us, and kind of get a little bit of a background on why we did certain things, right? So I do want to get into this in a second. But before we get there, because I think you just mentioned it already, but earnings season in the US is in full swing, right? And we've seen some, wild numbers, right? We go from, Facebook or Meta nowadays, right? Having okay numbers from a revenue perspective, but user growth is stalling, right? Like they're having some issues on that side. But then you're also seeing some of the investment banks having ridiculously good quarters, right, as well. So what's your point of view on that? And then let's go further than that afterwards and see, hey, how does our reoptimization looking at this going forward, right?
Yeah, I think the US earnings season is in full force. So far, more than half of the US companies have reported numbers. Apart from, I guess we all see Facebook or Meta in the headlines because of the outsized price reaction. But overall, the earnings season has actually been tracking quite well. So if you look at the number of companies that have beat the estimates, it's tracking at 76%. So this is quite in line with kind of historical numbers. In terms of actual EPS growth, companies have been growing at close to 30% this quarter year on year. So that's also actually a very, very strong number. Now, of course, these are kind of numbers in the rear view, and we have to look at guidance. And I think one of the reasons why Facebook has not or Meta stock price reaction was quite poor was because the guidance was actually very, very poor.
Yeah, completely at the aggregate S&P level, for example, forward looking 1 year forward. I'm just looking at a chart right now. The 1 year forward earnings per share actually is very solid. Earnings yield at around 5 percentage point of the index priced. And in terms of PE ratio, 1 year forward, we're close to 20x. It's still not very exaggerated. It's pretty healthy. The recent corrections made things a bit more attractive. But for the StashAway standpoint, in terms of valuation, in addition to looking at these metrics, we value these metrics against economic factors and interest rate factors. And from that angle, actually, overall S&P index is not cheap. They are actually more expensive than economic trends and values, but it's not like exaggerated. Tech is probably more exaggerated in making the correction, the bigger correction, right? However, there are places around the world that's why the reoptimization, because there are other countries relatively undervalued, there are other sectors relatively undervalued. So we're making those adjustments to maintain the efficiency of the portfolio.
That's great. And thank you, Freddy, for that explanation. And the same to you, Stephanie. For today, that's it. But we do have quite a lot of webinars coming up. So I do want to mention them before everyone gets off. And there's some cool ones coming up in February, and they're back-to-back webinars, actually. So if you go to the first one, make sure to also subscribe to the second one. The first one is She Invests by StashAway, personal finance and investing basics. So this is not just for women, it's also for men. It's a great event. We're going to have it in all of our different areas that we're available. So that's on Tuesday, the 15th of February. And that's at 3 p.m. in our MENA region, 6 p.m. for Thailand, 7 p.m. for Singapore, Malaysia, and Hong Kong. So you can join us for wherever you are. It's going to be super interesting. And then exactly a week later, on Tuesday, the 22nd, same times in each zone, we have She Invests by StashAway, Investing in New Beliefs with Thematic Investing. So if you want to learn about both of those topics, we are looking forward to having you. You can sign up in the links in the show notes below, as well as on our website, as well as on Eventbrite, and wherever else you interact with StashAway. With that being said, hey, thank you so much, both of you. I'm looking forward to being with you both again in a couple of weeks. And anyone else, if you have any questions, comments, please feel free to reach out to us at support@stashaway.com, as well as on the comment section below the video. Until then, we're looking forward to speaking with you soon. Bye-bye. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.